Okay. Okay. Interesting. Okay. Okay. Let's go and let's start to start to get people in. Any other? Actually, that's interesting. Any other macroeconomic questions? Canadian dollar. Yes.
For the assignment, I have some questions about that.
Okay. So assignment, we will do this. So there's two things I want to, let's say, meta things I want us to talk about. Exam and homework too. The first just being with the exam. Again, I get a certain level of fear from people about the exam, which I like to think is, I do not want to provoke. What is going to be on the exam? Okay, the exam, how am I going to make up the exam questions? And then you can figure out how you do it. I am going to basically go through the notes, okay, from beginning to end, and pick out things that, that I think someone should know after reading, reviewing, and hearing the lectures about it. Okay? I am not going, my goal is not to try to punish people. The reason I don't need to punish people is because I'm curving. Okay? If I wanted to, even if I did make it so the high score on the exam was 20%, I'm curving at the end. Okay? So my goal is not to punish people. My goal is to make sure that people read and review the notes and understand what we think of as being the important things to understand. So when you read it, when I talk, for example, about black shoals, is something I would say. It's important to know that a good question might be, how does the black shoals, or let's say, how is option prices affected by changes in volatility, changes in this? A bad question to ask would be to say, quote the Black-Scholes formula, okay, or derive the Black-Scholes formula. That is not the kind of thing that I would be asking, okay? So the right way to study for this is to review it, figure out what is important. Sometimes I go into more detail about things, technical detail about things, that is arguably less important, like a derivation, okay? Sometimes, So you have to sort of understand that. Any questions about the exam? Or how best to study for it? Okay? Several people had been concerned about that. Any other questions about the exam? Okay? Okay, the other question that I'd like to do now is to ask about the homework. Okay, and the homework 2. First question is, how many people have actually started working on the homework? Okay, and actually have runs going. Okay. What are your experiences? Okay, we had some questions about the simulator. We've had some questions about different things. I'd like to go through whatever questions people have about the homework. Okay? Any questions? Yes, questions.
For the data file, there are 25 files given by you. One of them is stock.data.csv. For the rest of them, there are dataset 1, 2, 3, 4, 5.csv.
Right.
The format for both of them are not equal. Yeah. One use the comma as a separator, while for another one it use space.
Okay, so what I'm hoping, and again, you can correct me if I'm wrong, or you guys who've actually looked at the files more closely can correct me if I'm wrong. There should be 2 classes of files there. There is one we're calling it stock data, I think you said, 1 through 5. Is that correct? .csv. 1, 2, 3, 4. Okay? And that's CSV, right? These are supposed to be price data on a bunch of stocks over a period of time. Okay? So what was supposed to happen, and you correct me if I'm wrong, or you guys correct me if I'm wrong, we took all the 500-ish stocks, okay, sorted them by essentially alphabetical order or some arbitrary order, and broke them into 2 subsets. We took the dates. There's a 10-year period from today to minus 10 years ago. We broke that time period into minus 5. And there are 4 quadrants then in the set of stock date space. Okay? And so the point being that if you ran it on this quadrant and this quadrant, the stocks and the dates are independent. So if you train a customized strategy for this one, okay, for this time period in these stocks, your performance on this time should be fair. Okay, it's a different time, it's a different set of stocks. These will be less fair. Probably this is still pretty fair because it's the same stocks but a different time period. This is probably going to be less fair. Because if you learn, for example, that back in this period of time that what stocks do is they go up, 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 up till there's an internet crash, and then they go down. And that's what stocks do. Then if you ran it on this quadrant, stocks will in fact do the same thing because it's the same time period. Right? Does everybody agree that if you could bet on stocks, if you had the stocks from A to M in alphabetical order over the same period of time, and then you wanted to ask, well, based on what I learned, could I now bet on stocks M through Z during that time period? You will see that because they're, we have this thing about specific and non-specific risk, right? All of these were clued into the behavior of the market at that time. The same behavior is here. So if you want to evaluate a strategy that you train in one quadrant, it is probably more meaningful to try it in another quadrant. Probably this quadrant is the best, but both these and these will be different time periods. Okay? And it is likely that any results you get will be more representative. Any questions? Yeah.
So which one is data set 1?
Which set is data set 1? Which is data set 2? Do you remember which is which? Which is which? 1. Let's just try this in color here. 1. Is this 1? This is 4? Which is 2? Okay. This you think is 2. This one we think is 3. Okay. Again, I encourage you to run everything on all. There's no harm to run it on all 4. You're only wasting compute cycles. Your PCs are plugged into the university computer. You're not even paying for the electricity, right? Okay. On the other hand, what we would say is I would expect there's certain strategies if you train yourself on one period. You have to do out-of-sample tests for it to be meaningful. If not, you're likely to discover you did great during the time that you trained it on. Okay? And not so great at other times. Or maybe not. You're writing the report, you do the experiments. Any questions? Does that answer? Then there's the other question. There's another file called, what was the other file called? So what, stockdata.csv? Data.csv. And what is that? That is going to be the entire thing. Okay? So the claim is the format is different. That is unfortunate. Okay? But it claims to be true. Okay? If it is a problem converting from one to another, use this. Okay? That's basically what we're complaining about. Okay? Yes? These are supposed to be now the combination of all 4 quadrants. Okay? The advantage of breaking it out into quadrants is we have separated from you training data and testing data, which might be helpful. The advantage of running it in all of them is that you run it in all of them and you see how the whole world works. Okay?
There is an interesting question. You can see that the size of the stock data.csv is not equivalent to the size of all 4 files.
Okay, so the claim is, when it's not equivalent, how big is this relative to these?
60 meg, that should be for the first one.
And how big are each for the 4?
15 meg for each. 15.
15 meg for each of these.
Yeah.
Okay? Well,
60.
one may be that the format is different. What?
What's the space and occupies one byte?
That's right. 45. The first one is 45. of the sum of the rest four are.
Okay, what you're trying to say is 45 is less than 4 times 15.
Yeah.
Okay, well, I'm not sure that's a problem. Because, first of all, there is some repeated data between these things. Like, for example, probably the name of the row. Okay? The main question is, does it make sense, the data that is there? Yes?
Maybe I can say something for this. Because I see the 4 data set files, the first column is the company full name.
Yeah.
But in the store data.csv, the first column is the stock number only. It introduces a big difference between the two, I think.
One is whether you have the full name or the stock symbol or something.
Because the full name is much longer than the stock symbol stored in the stock.
Okay. Let's say I don't care about the file size. I care whether the time series in there makes sense. Okay? Now, the one phenomena that some people have noticed is that some companies did not exist at the beginning that exist now. Google, no one had invented Google 10 years ago. Okay? So, under these cases, you may have a time series that goes in one and not in the other, or part of these things. To tell you the start and stop dates of each time series, we have another file called category. Okay, and in the category.csv file, you will get the start and end dates of each company. It conceivably is easier for you to read that one to get your data from, to start thinking about, and then read this file to play with. Or you can just read this file and parse it appropriately. Okay? Any questions about that?
There is another problem about the stock period card. The stock period card can only consider the open price and close price. What about adjusted close price?
Say that again.
Adjusted close price. It doesn't consider this input column.
Okay.
Because you can see that the stock base reach and match from time to time, so that the price will fluctuate very largely during this moment.
Wait, is what you're saying is that there is an open price and a closed price,
Yeah.
but no in middle of the day prices.
You can accept the order which contains the adjusted close price.
You're saying what you're saying that the simulator has a problem if I give it a, say, buy at the close or sell at the close.
Sell at adjusted close price.
So you say if I try to say sell at the close,
Yeah.
what happens?
And then there are different types of price you can use. One is open, another one is closed. For the last one is adjusted close. Yeah. Adjusted close.
Wait, no. I'm not seeing what you're saying. Tell me.
Maybe I ask in a different way.
Yes.
Because some stock handling some speed or merge of the item.
Okay.
I want to know is the simulator already handles this kind of things.
Okay, so you're saying that if there was a split or merge, okay, do our prices know about that? Okay? And the question is, we'll find out in a minute. Did you use what we call adjusted prices? Okay. So the short answer is we may very well have that wrong. Okay? So in fact, it may very well be, according to our current strategy, a good idea to buy a stock right before it does a reverse split, because then its prices will suddenly go up, right? Or it's a good idea to sell right before sell right before it does a split. Okay? So if that's the case, that's the case. There shouldn't be that many of them in there that I believe this dramatically changes the results. It would be better if we had used the adjusted prices. But that's life. Any questions? Yes, question.
When I generate the simple moving evidence, I have tried that my input file makes sense in some ways, but in both of the animator, the output result is a little bit funny because I can see that before the 2007 the number is reasonable, but after that, at the beginning of 2008, the number suddenly go up from exponential of 6 to exponential of 96. That means I can earn the money in exponential of 96.
Okay, so you're saying that, okay, so what you're telling me is, if I'm understanding you, the time period from 2008 behaved badly. Is that what you're saying?
No, because I checked the data, it seems because of there is no data in the 2008.
Okay, so according to this thing, how far back do you think the data actually goes in the data in the?
All the stock and it ends up to 2007.
Okay, so the claim here is what we're now saying here is, you're telling me that there is no 2008 data in the files. Okay, would that explain what part of your behavior? That if we have, are you flaking out in 2008 or are you flaking out in 2009?
I'm not sure what he should after the 2007 in the December. Maybe they should the stock all sell immediately. I don't know because I can see the trade amount is 40 million.
Okay.
There is a lot of stock I'm holding in the 10 years.
Okay.
Buy them is 40 million, and I suddenly sell all. I don't know it's reasonable or not.
Okay. So let's think what our solutions here are. Okay. So what I am understanding is everybody, true or false, do people believe that the results should be accurate up till the end of 2007? And beyond that, it's problematic. Is that what everybody agrees? You believe that? Is there anybody who disagrees with that? Is there anybody who does? Yes?
The main problem is that the evaluator will continue to evaluate until October of 2008.
So why not stop it before 2008? Yeah.
Right. So the logical thing is either to stop it after 2008 or disregard what happens after 2008. Okay? So you have, as I understand it, prints out a monthly total of what it's doing. Is this correct?
But
So so ignoring anything that happened after 2008 does not seem like a hard thing to do. Correct? Am I right about this? Please argue with me if not. Yes.
is this I need to calculate by hand for the December of 2007. Because at the
Well, then end it at November of 2007. Okay?
but I am holding a amount of stock at that price. I need to calculate the value of that stock.
Okay.
So just ask them to put them together.
So my guess would be we will discuss whether we can fix the simulator, but given the time constraints, I would say that it is better for you to figure out what the right interpretation is. It sounds to me like your problems will be solved if you sell everything.
Yeah.
And a hard code to think to sell everything in November of 2007. Do you
I
agree?
need to calculate by hand if I want to sell everything. I hold it.
Okay, let's go.
The evaluator will automatically sell the stock if the stock is no longer exists. I mean, the end date is need.
So the trouble. So he says that the stock will sell at the end of the simulation. Okay. Now the trouble, what you're saying is that the data runs out before the end of the simulation.
No, I mean the evaluator will automatically sell the stock if the stock date is stock that is ended.
So does it? So you're telling me that it will that it should behave correctly, even though there is no data in 2008. Do you agree with that?
But because I am reading my data is exponential to 96, it is quite an unreasonable number although I can see the trade number is 14 years, is this my strategy is so good?
Okay. This is something maybe that you guys should talk about after class to figure out what the issue actually is. Okay? My request is that you interpret it as fairly as you can interpret it. Okay? If there's a bug that you could identify, we would like to fix the bug. If there is a problem in interpretation, certainly you say things make sense before that. Is that correct? Like up to, let's say, like November of 2007, modulo your shorts, right? If so, you could price what the value of your shorts are. I claim you should be able to do it, take the data that he has, and come up with an intelligent interpretation of what your strategy is doing. Do you agree with that? Okay? So do it in a way that seems fair. And if there's a problem, I encourage you to actually talk and to try to debug that. Any other questions about the simulation? How many people have results that seem to them grossly sensible in some way? Okay? Meaning they can see that if they trade stocks, they make more than if they don't trade stocks. And that or anything like this. Is there anybody who has results from the simulation that makes some level of sense to them? Or is it completely random noise that you're seeing? Okay? Nobody feels the simulation is giving them anything except random noise. Who feels the simulation, the score evaluator is giving them random noise? Raise your hands. Who feels that the evaluator is not giving them random noise, but in fact is doing something sensible? One part, you say it's doing something sensible. Okay, good, okay. Then do what, okay, that's what I wanted to hear, okay? If you've got problems, send mail to me and UE. We'll try to fix it, okay? But I think it's doing sensible enough things that you can get a sense of what's going on. Any questions? Or if there's debate, now is a good time to have that debate. Okay? Any other comments about the assignment? Okay? How many people have got the baseline strategies working? Okay? You do. Okay? Who here does not yet have the baseline strategies working? Okay, yes.
No, I have another question.
Yes, please.
Because there seems to be so many parts in this assignment, when you differs a little bit of the data.
Okay. I am not opposed to this thing. Okay, I figured that was a good question. I'm willing to say that it is due a week from today. Okay, so you have the extra weekend to work on it.
That means next Tuesday.
Next Tuesday. Does that sound fair? Unless there's anybody upset about that. Well, at some point, to keep deferring it, I have to keep you in class longer than the end of the semester. We will discuss the project. For right now, I'm not necessarily deferring the project. Okay? I'm deferring this assignment till Tuesday. Okay? And I will think a little bit more about the project as to whether I can let you turn it in later. Actually, Mordechai, quick questions for you. When do grades have to be in at this school?
Does this course have a final exam?
Has a final exam.
It's 10 days after. It's 7 to 10 days after the final exam. There's an official final exam.
Okay, 10 days, you think?
7 to
7
10 days.
7 to 10 days. Okay, I will think about that. In the meantime, you have a week to finish up this homework.
Is the final exam official? Do you give it to the department?
I believe it is an official exam.
Okay, then it's 7 to 10 days after.
Okay, let's take a look at that. Any other questions about the assignment? Yes?
About the advanced strategies, can we do something other than the 4 units?
Yes, so what is my hope for here, this is an important point from some people. My hope is that you will use the baseline strategies to show what happens with a simple, well-defined strategy, or fairly well-defined strategy. The rest I want you to sort of play. That is basically what I want you to do. So if you don't like, I say you have to come up with 3 other reasonable trading strategies and evaluate them. Okay, I proposed a couple of them. Okay, but you are to use whatever you want, and your report will describe what you've done and how well they work. Okay, and if you have a reason for why you're choosing one of them, describe it in the report. That might be interesting. Okay? Now, when I talk about 3 trading strategies, I said technical analysis was one of them. Note that there's many infinite variety of different strategies you could base on technical analysis. So your 3 could be 3 different technical indicators. Okay? And that would satisfy what we're doing in here. Okay? Any questions? My goal is that you do experiments and play. Okay? And hopefully learn something. Any questions? The other thing that I would like to make clear is that you should do your experiments in as simple a way as makes sense to you. Okay? So some people are saying like, oh, how do I do constant rebalancing? Or buy an old when I don't have all the stocks at the beginning. What should I do? You should do the simplest thing that makes sense to you and do your experiments. When you tell me, oh, with my portfolio rebalancing, how often should I rebalance my portfolio? Okay? You should do what makes sense to you. Or even better than what makes sense to you. You might want to do a suite of experiments where you rebalance at different lengths of time. Okay? There's probably a parameter in your thing about how long it takes to rebalance. It might be an interesting experiment to change that rebalance time and see how the performance of the strategy changes. Any questions?
For
Yes.
the advanced strategies proposed by us, is necessary to be complicated like some nonlinear model for forecasting?
No, is the strategy have to be complicated? The answer is no. Okay? The strategy has to be a strategy. Okay? Do what you think is an interesting thing to do. Okay? In general, it is dumb if a strategy is too complicated. Okay? So simpler strategies are probably better than more complicated strategies. Okay? But think about what you want to do, propose things. Okay? And experiment and learn and play. That's kind of what I want to see happening here. Any questions? Any other questions about the assignment? Okay? So beat on it. Again, it's now due a week from today, and when you when you have a and so we have one more crack to talk about it on Thursday. But I strongly encourage everybody at least have done the baseline strategies by then, and hopefully played with something else, just to get some experience with this. Any questions? And if you have simulator problems, the person to email is me and Yi at cse.ust.hk. Okay? Any questions? Okay? And when you do it, the right answer to this mail is not my simulator. It isn't giving me the right answers. The right thing to say is, with this input file, it gives me this, and I am this output file, and I am suspicious because of this. Okay? And then it's possible to track things down. Any questions? Okay? Last time before we get into the lecture today. Any other questions about the assignment? Going once, twice. Okay. So what I'd like to talk about is, last class we started talking about this idea of doing competitive analysis as a way of thinking about trading strategies in a computer science-y way. Okay? Namely, to try to analyze a trading strategy in a rigorous way, in an asymptotic way. And the basic tools were the tools from online algorithms, okay, that we were going to be talking about how we score an online algorithm, okay? And online algorithms are ones where you do not have the future. You only have the past when you're making a decision. And as a future evolves, at each step you're required to make a decision. We are comparing a particular online algorithm, alg, with an optimal algorithm which knows the future. So we're going to live in a world where there are two algorithms. One is an optimal algorithm, which knows exactly what the future is. Okay? I can make all of its decisions, know it with full knowledge of the future, and does this in a way to maximize, come up with the best possible solution. We're comparing it to an online algorithm, alg, which at each step only knows the best. And we want to see how does its score do compared to the optimal one in the worst possible future. So over all possible inputs I, input sequences I, if we can find that our algorithm, our online algorithm, is never worse than a constant times the optimal one that did know the future, we say that our algorithm is C competitive, if C is that constant, okay? Or that function log n or something like that. And hopefully we can therefore, if we can show that we do pretty well, not knowing the future, compared to an algorithm that does know the future, then we know we're doing a good job. Okay? Any questions? Certainly if we could ever come up with a constant of 1, then we are literally predicting the future perfectly on all possible inputs. But that's too strong to hope for. Okay? Any questions? And we talked about this last time. We talked about, in particular, the question of how is it that you sell, if you have to sell one indivisible thing like a house, how can you sort of find a price that is a reasonable thing to sell at over time? Does everybody remember that problem? We were faced with the problem that we had to sell a house. We could only sell it once because it was an indivisible thing. And the adversary is picking what the prices are. We saw that if we couldn't use randomization, it was important that we set, the way that we would do it was we would set one fixed level, okay, with the property that if the price ever got up to that, we would sell it. If it didn't, we would sell it at the bottom interval. We say that somehow the prices fluctuate between big M and little m. Okay? There's sort of an upper and lower bound on what it might be. We looked at 2 strategies for how you might sell a house. One would be, we set this fixed value, which I believe was the square root of mm, okay, with the property that if we ever hit this price, then we knew we got at least this much, and this price was pretty good relative to the, because the moment we sell it, the adversary will say, ha ha, you could have gotten all that much, okay? Or, if we don't sell it at this price, the adversary will drop it and say, ha ha, you got to have this much. If we pick the right balance here, which was this, our competitive ratio would not be that terrible in either side. That was the idea that we looked at last time. Any questions? And we also looked at a better strategy, a strategy that did better, that was based on randomization. Okay? Where what we did was pick a logarithmic, define a logarithmic number of levels, okay? Based on m, 2m, 4m, 8m, dot, 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 until we got this one. Pick a level at random, okay? And sell the moment the adversary gave us a price better than that, okay? And we showed that this yielded a better, okay, ratio, competitive ratio than before. Any questions? Now this was the case where we were selling a house. A house has the property that you can only sell it once, right? And you have to sell the whole thing at once. When we talk about one-way trading, okay, this is a world problem which is a little bit different. I have now not a house, but I have stock in, let's say, HSBC. That's what you guys have here. Let's say I have a stock, a certain amount of stock in this. And I'd like to sell it all to get cash. Now, the interesting thing is, there is no reason here why I have to sell it all at once. Does everybody see that if there's a time period over which a price is going, okay, I'm fighting against an adversary over a period of time, there is going to be a fluctuation in prices. If it's not a, I could conceivably sell it all in one mass, and use the house algorithm that we talked about. Or I could try to trade a different, sell different amounts over time, okay, in the hopes of doing better. Does everybody, I've said that kind of clumsily, but I think it should be clear. The difference between a house and stock is I don't have to sell all my stock at once, okay? And if I wanted to change my position from beginning to end, I can now think of a strategy where I sell it at different prices at different times to try to maximize my return. Any questions? Now, in the real world, if I was trying to liquidate stock, it's important that I do not try to sell it all at once. Suppose, let's say I have, $1 billion worth of HSBC, and I want to get out of that position. What is going to happen to the price of HSBC in a real market if I suddenly try to sell a huge amount of shares? What is going to happen? Okay? Because again, in a real market you have buyers and sellers, and there is somehow the price stays the same so long as there is a balance between what the buyers and the supply and demand. If I suddenly dump a huge amount of stock on the market, anyone who wants to buy it can buy it. But the number of buyers at this point will quickly get saturated, and the price will have to drop in order to find enough people willing to take that whole supply of stock. Does everybody see that? So it would be a bad strategy if in real life for me to take my stock and immediately say, just sell it all now. Because that will depress the price before I can realize that whole deal. Right? And so that suggests that in reality, when people are asked to move in and out of a position, when traders do that, they are faced with a problem like this one-way trading problem, where they have a certain amount of time to try to unwind the position. And in that case, in the real world, the concern is going to be they're going to want to break the order up into smaller orders and presumably release them slowly over time so they don't sort of warp the supply and demand balance so much, and they don't lower the price artificially when they're trying to sell it. Any questions about that? So it should be clear that this one-way trading strategy problem is a real problem faced by real traders. Okay? Any questions? Now, what might be a strategy we can use? Let's think about this. Now, if you are faced with this problem, you are now trading for whatever company you're now employed as a trader. Okay? You are told to to liquidate a certain amount of stock. The price is doing something. What would be your strategy? Can anyone suggest possible strategies for this kind of a thing? Okay? Let's just think about intuitive strategies and how they might do against an adversary or not. Okay? Does anyone want to propose any strategies for this? Okay? Any ideas at all? Okay? One idea that might be you divide the time period into a certain number of units and sell at a regular period of time. Okay? In that you sell a certain amount at each time. Does that make sense? Okay? And this would have the property you wouldn't be oversaturating the market. And if the market spent half its time high and half its time low, half the time you might expect to get a good price, right? So that's not an implausible strategy, but not the kind of thing that would work against an adversary. Why is it? If you agree that you're going to be selling it at these intervals, okay, what would the adversary do? It would keep the price low, okay, low, low, and then maybe in this point for a second, just to frustrate you, it would pop up briefly, Okay? And so if you sold it at fixed intervals, the adversary could make you have the worst possible outcome. Does everybody see that? Okay? Any questions? Okay? So selling it at purely a time-based strategy will not help you against an adversary. Any questions? What might be another approach? If we want to guarantee ourselves a reasonable ratio, suppose, let's say, that I know that there is a ratio of C that can be obtained, a competitive ratio of C that can be obtained. Okay? Meaning that there is a way for me to do, before we sort out, there's always a way I could have a competitive ratio of log phi. Let's say that I know that there is some C star, that there exists a strategy that I can always get that my competitive ratio will be C star. But I don't know what the strategy is. Okay? What should I do? As time's going along, okay, let's say originally the price starts out very, very low, okay, and it suddenly starts to peak up a little bit, okay, I am now faced with a decision. Do I sell it at this point or not? Or do I sell some of it at this point or not? Right? How can I make that decision? Well, one way to do it is, if I know that I'm going for a competitive ratio with a value of this, I can figure out what would happen if I didn't sell some now. Okay? So let's say that I was looking for a competitive ratio of C. Let's say C was equal to 3. I don't know if I can do it or not. Right? So long as the price was below 3 times M, or C times M, then it didn't pay for me to sell anything at all. Right? Because if I ended up selling it at the bottom price, I will have gotten still within a constant C times optimal. Right? Does everybody agree with that? Now the problem is, what happens when it gets a tiny bit above this? Okay? If I am now going to have a value of C, competitive, if I'm going to achieve a competitive ratio equal to C, I have to sell some of it now. Right? Do I sell all of it? Does everybody see what I'm saying now? The moment it peeked its head above here, if I don't sell some, the adversary can instantly say, ka-chunk, go back down here. And you didn't get your value ratio of C. Does everybody see that? So the real issue is now, once it pokes up in response to this, how much should I sell now? Okay? If I sell too much, what will the adversary do? What will happen in the future if I sold too much? The adversary wants to hurt me. It will do what to the price? Jack it up, right? Ha ha, you sold out too much now. I have to sell something or else it'll jack it low. If I don't sell something, okay, if I do sell too much, it'll jack it up here. What I need now is what I'm going to call a threat-based strategy. Okay? What I am going to do is sell only when the price hits a new maximum. Okay? And the amount that I'm going to sell is just enough to ensure that I achieve a competitive ratio of C. Okay? Even if the price now drops to M. Okay? Does this make sense now? Let's think about what it is. If I know what my C is that I'm aiming for, and I'll know that there always is that it is possible to achieve this C, by doing the proper analysis of figuring out what that is, it should be clear that there is an amount that I can sell every time it hits a new maxima to guarantee that I will always have my competitive ratio of C. Okay, I will not sell anything until it hits CM. Once it hits CM, I will probably sell just enough to guarantee, again, once it gets above CM, okay, let's think about how much do I have to sell if it hits this price. Well, I have to sell enough so that I will be within a factor of C of optimal if it drops down. Okay? From this point on, if this is now some value, let's just call this thing, P. Okay? If it hits this point, okay, I now have to face a decision. If I don't sell something, okay, the price will drop down immediately and I will have not achieved my value of C. On the other hand, I have to buy enough so that if it did, my average return, okay, which is going to be from what I sold it here and what I sold it here, was within a constant of having sold it back there. And that gives me a parameter for how much I need to sell now at that price. Any questions? Okay.
It's going to be a constant. It's going to be a constant portion.
Well, I don't know what the future. I'm working against an adversary now, right? So time is not really a dimension for the adversary, because the adversary can change things arbitrarily quickly.
No, the part that's bothering me is the adversary just flips you back and forth between two breakpoints there.
Okay?
And forces you to sell off a lot. And then after you've sold off a lot, it jumps you, it goes to the max.
Well, the claim is C here is the achievable amount. The achievable optimal competitive ratio achievable for this problem. Okay? So suppose I know what kind of a competitive ratio is achievable for this problem. Then, in fact, what's interesting is my strategy is well defined once I know what this competitive ratio is. Okay? Because if I am now faced with a decision here, okay, how much do I sell? Okay? If I don't make this decision, the adversary can then screw me. Okay? So I would have to say that there's going to be a certain fraction of it I'm going to have to sell once I get up to that point. Okay? Any questions about that? Yes?
I know how can you decide the C star,
Okay, so the problem here is where does this come from?
Yes.
Okay? Now let's think about it. Okay? The claim would be this has to come from some kind of a detailed analysis. Okay? Does everybody agree that somehow this is now a complicated question of what C star is available? Okay? And this now becomes an analysis question. Okay? We know some C stars are available. We know log phi is available. Why is log phi available? That's what it would. We could have done this, okay, with if we had tried to sell the house using the randomized strategy, right? In fact, the randomized strategy is another way to look at this thing. One possible way to think about the randomized strategy was remember that there were a bunch of levels, okay, that we had here defined, right? And what we did with the randomized strategy was pick one of those levels at random and sell at that. Another way we could achieve the same bound but would be if we took, for each of these k levels, these log phi levels, if we put 1/k of our income on each of these levels and sold whenever it crossed that level, that is enough to sort of realize the same log phi strategy that we had had before. So one way to think about what we could do is we could simulate our randomized strategy by putting 1/8 of the money total of our assets on each spot. Okay? And then that would give us C equals log phi. In fact, the question of whether or not we can do better depends upon whether there is a better constant here. Okay, and this reduces to now doing the analysis more carefully. To figuring out what the asymptotically optimal one is. So what's interesting is it clearly exists a best constant. Once there is a best constant, the threat strategy will realize it. And I claim that what we are left with is an analytical problem of what is the best constant. Okay?
Sorry, technical question.
Yes.
Why does there have to be a best constant? Why can't it just be supreme?
Why can't it be a
Why
what?
can't it just be supreme? Why does there have to be a best constant?
You mean a constant as opposed to reaching a limit or something like that? Let's say
You get arbitrarily close. If you split yourself up into fine gradations.
right.
Right.
Okay, offhand I don't see an argument as to why it can't be like that. What it is clear is that if you have a limit in mind, okay, it's pretty close. If there is a constant, this is clearly a way that you would achieve it. Okay? That much I think is clear. Okay? Any questions about that? Yes?
You say you divide the money into the K slot, but is divided evenly, but how can you decide the upper limit of the slots?
Well, so we assume just like with our previous problem, the prices can move between a big M and a little m.
Yes, how do you know the big M?
Okay, so now you're asking for a question about our model, okay, assessing the model, okay? So the first thing that you're saying is that assumptions of the upper and lower bounds on price movements seem suspicious, okay? Although usually, I claim, you could make safe upper and lower bound estimates if you want. What is a lower bound on what Google's price will be? Does anybody tell? I don't think Google can go below 0. Does everybody agree with that, right? What about an upper bound on Google? Well, maybe they can't come up with a real one, but you can certainly say that, gee, it's extremely unlikely over the next month of trading that Google's going to go up to $1,000 a share. Okay? And so long as you can come up with upper and lower bounds that are meaningful using historical data, this is potentially meaningful. Okay? Any questions? Okay, and if the world changes completely, then the strategy breaks down. Okay? But I think this is not the biggest, let's say, problem that you have. Okay, I claim the one issue with upper and lower bounds, is the strategy performs, the quality of how well it performs is a function of this phi, this ratio between the upper and lower bounds. And so the wider you make your upper and lower bounds, the less good your results will be in terms of absolute dollars. Okay? So the argument is this would be an assumption that if you assume this model, you're basically making upper and lower bound estimates. The tighter the estimates you can make, the better. Okay? The tighter estimates you make, the less likely that sometimes you will actually go outside of it. But I claim this is now something that you can think about, okay, from in terms of designing a possible strategy. Any questions? The bigger question, though, has to do with how good the guarantee is. If we say, let's say, that you do half as well as optimal, okay, how good is that? And this is a harder question to answer. Suppose we had a competitive ratio of C. You would be doing half as well as somebody who didn't know not knowing the future, as somebody did knowing the future. Okay? Is that good or bad? Okay? We're not used to thinking about strategies that way. You're used to thinking about, let's say, when we think about, let's say, how is it that traders score, maybe you'd be talking about the difference between an investor and different mutual funds. The difference between a manager of a good mutual fund and a not good mutual fund is only a few percentage points often. So a guarantee that, hey, you're going to do half as well as optimal, that actually, it's not clear whether that's a good strategy or a good guarantee or a bad guarantee. Okay? Because first of all, the fact that it's a half means there's a wide range, much wider than the few percentage points difference you see in real trading strategies. On the other hand, we're comparing ourselves to optimal instead of to, let's say an index or the best possible the best performer observed. So it's a little hard to assess how good these guarantees are relative to other things. Okay? What is interesting is these sort of randomized heuristics and threat-based heuristics seem like natural and reasonable approaches to doing one-way trading. And that this online algorithm thing gives us a way to score it. Okay? To assess it. Any questions? Okay. There are other areas of portfolio management and stuff like that we can start to assess with these online strategies. One would be, suppose we have a market. This is now when we talked about the trading strategy. How do I get out of one position into cash? Another argument would be, suppose we live in a world where there are S different types of assets. They might be cash. I could hold cash, stocks, or bonds. Okay? Or maybe I could hold cash, Google, Microsoft, or however many different things I can hold. The question is this. If there are a bunch of different asset types, and there are, I have a certain amount of money, how should I partition my money among the assets? Okay? If I want to have my portfolio do well. So now, what is the world here? The world is we are given, that we are allowed to invest in a couple of different asset classes. One of them might be cash. Cash will give me this much value, at constant value at time. Okay, if I have a certain amount in cash, the reward is going to be, if I have cash that doesn't pay interest, that's one thing, right? If I invest in stocks, there's times when stocks will be doing really well, and times where stocks will be doing really badly. Does that make sense? This is stocks. If I wanted to design my portfolio, if I knew the future, how much money would I put into stocks and cash at different times? It should be, what would be the optimal strategy if I knew the future? If each day we live in a world where there is a return, okay, on a particular asset class, and that return on the asset class changes each day. If we now have a table, maybe that's easier to think about. Here we have the asset classes, cash, stocks. Here we have the returns each day. For cash, the returns are constant. You get the same amount of money you put in. In stocks, sometimes the return was 1%, was let's say 1.505, meaning it went up 5%. Maybe it was 0.96, it went down 4%. If these are multiplicative numbers, some days there were positive returns, some days there were negative returns. The question is now, if I have a portfolio, how would I split it among these different asset classes in order to maximize my total wealth at the end of the period? Okay? That's what we mean by online portfolio selection. That's in fact exactly what you guys are doing in this homework, isn't it? You've got as input a set of possible assets you can trade. Okay? There is going to be a given return each day. Okay? Or you can hold cash. The question now is, how should you move your money among these different asset classes in order to maximize how your portfolio does? This, I claim, is exactly the problem that you have. Any questions? What are possible strategies? One strategy is the buy and hold strategy. This is one of the things I ask you to do as a baseline. Okay? It suggests that you not attempt to modify your portfolio for long periods of time. Perhaps in this case you put half your money in cash and half your money in stocks. Okay? Suppose you do that. How good is your performance going to be compared to the adversary? Let's think about this. Okay? Suppose we live in a world where there's only two asset classes, stocks and cash. Okay? A buy and hold strategy might say, put half of it in stocks and half of it in cash, and then forget about it. Does that make sense? Okay? Now, buy and hold is generally a good strategy in certain practical ways. One is if you pay transaction costs. There is less transaction costs than you would in an actively managed thing. In your simulation and the analysis we do, we don't pay transaction costs. But in general, that's sort of a strategy. Okay? Historically, as we saw, trading strategies that people do that involve less movement of positions. I showed you some statistics the other day. Did better, okay, than more actively managed strategies. So this buy and hold strategy makes a certain level of sense. Okay? Any questions? The other class of strategies in this kind of portfolio optimization thing, okay, that might make sense is what we would call, are ones where we do try to actively manage what we're doing. Okay? One class, the one that I want you to do a baseline, is one that does a constant rebalancing. What does that do? It says that you take a look at today's, you start out, you put half your money in stocks and half your money in cash. Suppose you do, and that day the stocks have a great day and the price of the stocks double. Cash stays the same. At this point, how much money do you have in each one of the asset classes? You originally had half of your dollars in stocks. That doubled, and now you've got $1 in stocks. Okay, so let's say that we start out with $1 total. We put half of it into stocks. If it doubles, now we've got $1 of stocks and 1/2 in cash. Does everybody agree with that? By the constant rebalancing strategy, what we would now do is sell some of our stock and put it into cash in the next round. So we have an equal amount in each asset. Does everybody see that? How much would we sell from the stock to do this? So if we sold 0.25, then we would have 0.75 here and 0.75 here. Does everybody see that? That's what I mean by a constant rebalancing strategy. Now, why might this be a good idea as opposed or a bad idea? Let's think about this a little bit, because this is kind of a very fundamental and important strategy. Okay? One argument would be to note that let's think what happened in the crash that we just had. Okay? Most people, if you had, how many people own stock? Okay, of some type. Okay? Many of you probably put it in, the index was going up, 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 up. You looked at your newspaper every day and you felt, I'm richer, I'm richer, I'm richer. Right? And then everything collapsed and you lost everything and you're back to the original place. Does everybody agree with that? What would have happened if you did a rebalancing strategy here? Every day that the stock went up, you're stuffing some of it into cash. Does everybody agree with that? You may say, wait, but I'm taking away from this high performance thing that keeps growing. Yes, that's what it's going to do. The more successful asset class, you would move money from the more successful asset class to the less successful asset class. Okay, that's what this does. Which in some sense is a counterintuitive thing to want to do. Right? On the other hand, okay, it would have protected you against a crash in the asset. Okay? Any questions? In general, what happens is when you have a diversified strategy like that, you can still pick up exponential growth, okay? But but also provides a way to basically by doing this constant rebalancing, you can pick up on the exponential growth, okay, and yet avoid the worst aspects of a crash. Any questions? Okay. Any question about what the intuition here is? When we think about this thing analytically, okay, and we think about it from a point of view of if we want to come up with a trading strategy that's as good as possible, we have to look at some of the pathologies that come up with active management. Okay? Suppose we had a future with the fact that stocks went up, down, up, down, up, down, up, down, up, down, up, down every other day. Okay? And they either went up by a factor of D or down by a factor of D. Okay? Every day. And these are multiplicative returns. The right thing to have done in a world where there was stocks or cash would, of course, be on odd numbered days to have your money in stocks and then sell it and put your money into cash. This would yield a return of what over n days? There'd be n over 2 periods where you multiply your wealth by D. Here's an example where if you always knew the future, you could get D times n to the D raised to the n over 2 wealth after this period. Okay? Where, if you just did buy and hold, you would get at most the first day's benefit, which is D. So buy and hold has the property that it is good for in certain ways. It avoids, you can take advantage of sustained periods of boom. If you know what the future is, buy and hold can do very badly compared to an adversary. Does everybody see this? Okay? That the buy and hold strategy would have only had a small return, whereas the active management, if you knew the future, would have been extremely high. Okay, so we want to start thinking about online algorithms. Buy and hold cannot guarantee itself a very good performance. Okay, in this kind of a regime. Any questions? Excuse me, what? What?
Extremely excellent.
You found that buy and hold was very good in the simulations?
Yes, even a lot better than the art or the sophisticated one. Yeah.
Okay, so you're saying that did well. Well, buy and hold is a good thing. Okay, so you're saying buy and hold did better than let's say which one did? You said buy and hold did better.
The rebalance or the technical analysis or pair trading or any other sales.
Okay, well now why is that? Let's think of, first of all, that may be true. Okay, now first of all, what does that mean? Okay, part of it has to do with what period of time you are living in. Okay? Buy and hold would not have been a great idea, okay, if you had bought it 10 weeks ago, right? Okay, because everything has dropped in the world. What period of time did you test yourself on?
10 years.
10 years.
At least for 10 years. The return rate is around at least 6% per year. Is not bad.
Okay? So one thing that was true with buy and hold was, let's think about what that did. Over this 10-year period, there were what? First of all, it doesn't have the downtime of now, because you say it ended at the end of 2007, right?
Yes.
So buy and hold might have looked less good, by the way, if we had this year in place, right? But what was in this world? There was a boom period and a down period and then another boom period, right? So in fact, buy and hold should do pretty well, okay, given that history of time, okay? And this is an interesting conclusion to come up with, okay? If buy and hold is not a good, is not a, is not it does about as well as any other strategy. That's an argument that simple strategies are probably a good idea, and that's not a bad thing to do with your money. That would be a useful lesson to take away with your life. Any question? But one way might constant rebalancing be better than buy and hold. Okay, though. Which do you think would probably have a lower volatility? Okay? Which do you think would actually have... So I can kind of believe... How did buy and hold do compared to constant rebalancing? A lot worse or a little worse? You're saying that it did 1,000 times worse, okay?
Yes.
That I find a little surprising, okay? And there might be a bug there, okay? But what I would probably argue is that, yes, you would expect, by the way, the returns. Let's think, though, about it. If we wanted to compare the constant rebalancing one with the buy and hold, I might believe that buy and hold would do better. But which would show a better... Which would show more risk, more volatility? Clearly, buy and hold is going to show more volatility than a constant rebalancing thing. Why is that? Because if we think about a world, again, where constant buy and hold did great, so long as you did not have a down period in the market. Does everybody agree with that? If you had a down period, buy and hold was bad. Okay? The other way to assess these strategies, again, maybe I should get getting distracted here. The other way to assess these strategies is not just on return, but also on volatility. If you wanted to capture this a little bit further, you might want to also look at what is the standard deviation of your wealth or your returns over this period of time. Okay? And we might be more interested in a strategy that shows less return, but better, but also lower risk. Okay? And I argue the constant rebalancing thing, especially where you're leaving some of it in cash, okay, is going to do that. Any questions? Okay? Let's go on. Okay. So, there are other kinds of questions here. And a two-way trading is sort of, we want to analyze these kind of trading strategies. The right model to think of it is a simple special portfolio case called two-way trading. You only have cash, and you only have one other security. Unlike the one-way trading where we were trying to move our money from stock to cash, we have a world where we can shift our money back and forth between the two asset classes. That's what you can do with your portfolio optimization. The two-way trading here is a special, simple case where you've only got two securities. Okay? Any questions? One being cash. If so, the optimal strategy, the offline strategy, is clear. Read tomorrow's newspaper. Tell me if the stock class is going to be up or down. If it is up, put everything into the stock. If it's down, put everything into the cash. That would be the offline strategy. And that's clearly the optimal one. We might ask ourselves, in a two-way trading strategy, okay, is there a way we can guarantee ourselves a positive return? Okay? And the answer turns out to be no. Okay? But you might guess. Suppose we are competing against an adversary. And we're going to be playing a bunch of different games, okay, over time, where I can put either my money into stock or to cash. Okay? Is there any way that I can guarantee myself good returns or always making a profit, even if there's a profit to be made? The answer turns out to be no. Suppose that the first day of the trading period, you're going to have to do something. You can either put your money in cash or in stock, right? If you put all your money into stock or a lot of your money into stock, the adversary can wipe out stocks that day. Okay? Have a terrible, terrible day. Yet the rest of the time period show a positive return in stocks. If you had put too much money into stocks the first day, you would have had a terrible performance even though stocks were positive almost all the period. If you put too much money into cash, the adversary can jack up the stock that one day you weren't in the market and then punish you the rest of the time. Okay? So when you look at what adversaries can do, if you allow too powerful an adversary, there is not going to be a fair strategy here. Okay? And so when one tries to, let's say, look at this from an online perspective, the more interesting results come from when you assume an adversary has a certain constraint. We say that an N-phi trading sequence is a day period, is an N-day period, where the optimal offline strategy will make at least phi. If I know that there is a strategy which will give us phi, then there in fact are ways I can go and trade in such a way that I can guarantee myself a positive return over this period. Okay? We don't have enough time to go through it, but basically I can show you that there is a way I can make a small positive return from these things, okay, if I wanted to. Any questions? And the final punchline, which I don't think I'm going to get to, is there some other model? I may go through this more carefully next class. I haven't decided. But one thing that's interesting is that when you look at some of these models more carefully, you end up getting things that look a lot like binomial trees, okay, as suggesting what the right strategy is to do with it. I may decide to talk about this more next class or not. If I don't, you can read it if you want. If I do, you'll hear it again. Any questions? Any questions about the homework assignment? Okay? Any questions about anything? If you have any questions about the simulator, now is a great time to talk to Yu Yi. If not, beat on it, and we'll talk more about it next class. Okay? Thanks for your attention.